Stop! Before you go any further, tell me something. When was the last time the rules actually worked in your favor? Not in theory, not in a brochure. Actually worked. Because here's what I've noticed. The people who follow every rule, who pay on time, who show up, who do exactly what they're told are the ones who end up with the least. And the people who understand how the rules are written, those are the ones building wealth quietly, while everyone else is waiting for their turn that never comes. That gap isn't an accident. That gap was engineered. Here's what nobody tells you at school, at your first job, at the bank when they hand you your first account. The system you were handed, the save your money, pay your taxes, buy a house, trust the bank system, was not designed to make you wealthy. It was designed to make you compliant. There's a difference. A compliant person pays 33% of every dollar they earn before they see it. A compliant person puts money in a savings account that earns 2%, while the bank lends it out at 7%. A compliant person pays off a 30-year mortgage in 28 years and thinks they won. You didn't lose because you were lazy. You didn't lose because you didn't try hard enough. You lost because you were playing by rules that were written before you were born, by people who were already on the other side of them. Here's what that looks like in real numbers. The average Canadian household earns roughly $90,000 a year before tax. After federal tax, provincial tax, CPP, and EI, they take home approximately $67,000. That's $23,000 gone before a single bill is paid, before rent, before groceries, before a dollar goes toward anything they chose to spend it on. $23,000 extracted automatically every single year the moment the paycheck arrives. Then the spending rules kick in. Rent or mortgage, the biggest single cost, takes another $18,000 to $30,000, depending on the city. In Toronto or Vancouver, that number is closer to $30,000. In Calgary or Edmonton, closer to $18,000. Either way, you are now at $45,000 to $53,000 spent before food, transportation, insurance, or anything that actually makes life livable on a $90,000 income, and you followed every rule. So what do you do when the rules are rigged? You stop playing by the rules you were handed, and you start playing by the rules that actually exist. Because here's the thing, the rules were not hidden from you out of malice. They were hidden from you because nobody who benefits from your ignorance had any incentive to explain them. But the rules are public. They are in the Income Tax Act. They are in the TFSA legislation. They are in every financial product the government created and then forgot to advertise properly. There are 3 rules the other side has been using since before you graduated. Rule 1, shelter income from tax before it's taxed, not after. Rule 2, make your money work at the rate of the market, not the rate the bank offers you. Rule 3, own assets that grow, not expenses that drain. 3 rules. That's it. Everything else, every sophisticated strategy, every financial product, every tax optimization is a variation of these 3. Let me show you what this looks like in practice, not in theory, not in a retirement calculator with optimistic assumptions, but in actual Canadian dollars right now. Rule 1, shelter income before it's taxed. The RRSP gives you a deduction on every dollar you contribute at your marginal rate. If you earn $90,000 in Ontario, your marginal rate on the next dollar is 29.65%. A $10,000 RRSP contribution saves you $2,965 in tax this year, not deferred, gone from your tax bill this year. That $2,965, if invested immediately at 8% annual return, becomes $13,800 in 20 years. The government handed you nearly $14,000 in future wealth and called it a deduction. Most Canadians use it as a savings account. Rule 2, make your money work at market rate. The average Canadian bank savings account currently pays between 1.5 and 4.25%. The global stock market has returned an average of 8% annually for the last 50 years through crashes, recessions, pandemics, and wars. A $50,000 difference in where your money sits, compounded over 30 years at that gap, is the difference between $216,000 and $503,000. Same money, different rule. Rule 3, own assets that grow. The average Canadian car costs $1,200 a month, all in payment, insurance, fuel, maintenance. That same $1,200 a month invested in a broad market ETF over 10 years becomes $220,000. The car, after 10 years, is worth approximately $3,000. The difference between those 2 outcomes is not income, it is not luck. It is which rule you applied to that $1,200. The math isn't complicated. That's the part that should make you angry. This is not advanced finance. This is not something you needed a degree to understand. The reason most Canadians don't know these three rules is not because they're unintelligent. It's because the institution that could have told them the bank makes more money when you don't know. A savings account at 2% earns the bank 5% on your money. The spread is their profit. Your compliance is their business model. The Canadian government collects $23,000 a year from the average household in payroll deductions. It then created the RRSP, the TFSA, and the FHSA, three separate vehicles that legally reduced that number significantly. It created these tools, made them public, and then watched as the majority of Canadians either didn't use them or used them incorrectly. The tools exist. The rules are public. The gap between knowing and not knowing is worth, over a working lifetime, somewhere between $400,000 and $800,000. That is not a rounding error. That is a retirement. That is the difference between a life where money is a source of constant pressure and a life where money is a solved problem. And it was available to you the entire time. Here is what I want you to do before this video ends. Not next week, right now. Pull up your last pay stub. Find the line that says federal tax withheld. Find the line that says provincial tax withheld. Add those two numbers together. That is the amount the government took from you this pay period before you made a single decision. Now ask yourself, how much of that could you have reduced with a legal, government-designed tool that has been available to you this entire time? Then pull up your bank account, find your savings balance. Find the interest rate it's earning. Multiply that rate by your balance, and compare it to what 8% on that same balance would produce in 10 years. That gap, that specific personal number, is the cost of the rule you were handed versus the rule that actually works. It is sitting in your account right now, measurable, concrete, yours to close. Open the account, run the number, then come back and tell me what you found, even if it's not what you expected. Here is what makes this particularly sharp. The TFSA Alone One account, available to every Canadian over 18 since 2009, has accumulated contribution room of over $95,000 for someone who has never contributed. That is $95,000 that could be sitting in a market ETF right now, growing at 8% annually, completely tax-free, never reported on a tax return, never counted against a government benefit. The government built that vehicle, funded it with your own money, and then never sent a single reminder, because nobody who profits from your savings account had any reason to remind you.